over the last 5 years in this indice, gold's up almost 60%. It's up almost 10% this year alone. And what that tells us is that gold is doing its job for the majority of the world. It's just the dollar and its inordinate strength, which, if you really think about it, is it really justified, or is it just the nicest shirt in the dirty laundry basket? And, we really don't see things quite as clearly here because of the strength of the dollar, but I assure you the rest of the world does. And when you see gold up 60% in 5 years, when you see it up 10% this year, in every other currency, when you see it at all-time highs in the second and third largest economies in the world, it is real.
Andy Schectman, the CEO of Miles Franklin, has been drawing attention to growing concerns within the banking system. He points out that bank deposits have declined, raising the specter of potential bank bail-ins before the upcoming presidential election. Schectman also keeps a close eye on the de-dollarization efforts by the Brics nations. Gold prices have historically experienced significant fluctuations over the past century. Notably, the lows of the 1970s were followed by an all-time high in 1980. Since the 2000s, gold prices have generally risen, albeit with occasional sharp fluctuations. According to Schectman, when gold's price increases by 60% over 5 years and spikes by 10% in a year, it signals a tangible trend. In the context of banking concerns, it's important to note that the U.S. legalized bail-in relief with the passage of the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act, a response to the 2007 and 2008 financial crisis. Specifically, Title II of Dodd-Frank established the Orderly Liquidation Authority, OLA. This mechanism prioritizes investor risk over depositor risk when a bank faces trouble. Schectman believes that if a bank undergoes a bail-in, where depositor funds are used to rescue the bank, it will capture the public's attention. He speculates that such an event could occur before the year ends or before the next election. In light of recent events and the potential for change, Schectman suggests that considering investments in gold and silver may be prudent. Just before you watch Andy Schectman's interview, make sure to subscribe to our channel and give this video a big thumbs up.
Last week, Monday, we saw all-time highs in the second and third largest economies in the world in gold, with Japan and China. You have gold up in, if you look at it, there's a indice, and all you need to do is put a dollar sign in front of XAUWCU. This is a basket of currencies and economies from the 20 largest economies in the world. If people think a country that is 155 trillion in debt with 5 trillion in assets, that is splintered all around its unification around the country and is being methodically de-dollarized around the world, is really something that should be or deserves to be as strong as it is, well, then I guess they won't get out of the way of what's coming. They won't even know that it's coming. But if you think about it, when we pride ourselves at being the world reserve currency and our 155 trillion in debt, Medicare, Medicaid, Social Security, government, military, pensions, on top of the 32 trillion with 5 trillion in assets, the largest being student debt of over 40%, should we really be as strong of a currency as we are? And that's why you see gold up 60% around the rest of the world in the last 5 years. So right now, ironically, because of this recency bias and this normalcy bias, it's, I think, probably the best environment to buy gold and silver we've seen in 4 years. And price, premium, availability, and the reasonings to do it. And sometimes I feel like, I'm screaming at a wall. The mainstream hasn't awoken yet. And I will say it again. The mainstream's going to wake up when a bank is bailed in. And I would bet anyone $1,000, anyone, that we will see a bank bail in, I want to say before the end of this year, but for sure before the election, we will see bank bail-ins. And when that happens, that's when the public wakes up, because everything we've ever talked about is not enough to make people pull their head up out from underneath their checkbook and their computer screen to say, my goodness, what do we do now? Part of what I think anyone who has an argument must be able to do is to, with an open mind, look at both sides. And that's part of what's lacking in this country, right? Where you can't have a discussion without it becoming heated, where you can't respect someone else's viewpoint. And if you never do that, you never learn, you never grow. You have to listen. I think a lot of the stories I read talk about, well, China and India just simply do not like each other, and the problems with Kashmir are something that can't be overlooked, that they won't be able to get by it. And the bottom line is simply this, is that I do believe in many cases, a lot of these countries are looking past their history with one another. I mean, look, you don't have to go any farther than looking between Iran and Iraq and Iran and Saudi Arabia. A railway being built between Iran and Iraq, and embassies being built in Saudi Arabia and Iran between the two countries, and relations being restarted and on a friendly basis. The fact that these countries are now part of the Brics naval alliance, these countries who never got along. So why is it so hard to believe that China and India can get past this? So, you talk about this group. We just mentioned how they have the natural resources like the grains and the soybeans and the rare earths and the uranium and the titanium and the aluminum and the gold. But we've also said they possess two of the three largest nuclear arsenals, but now they control the Persian Gulf and the Straits of Hormuz between Saudi Arabia, United Arab Emirates, and Iran, the Suez Canal with Egypt, the Straits of Magellan with Argentina, and a large portion of the Eurasian continent landmass with Russia, China, and Iran. They now have the 5th, 10th, 11th, 18th, and 23rd largest economies in the world, along with 5 others. And so little by little, this is becoming real.
Schectman is concerned about the trend of money leaving banks and flowing into the Treasury and other destinations. This is causing a shortage of money in the banking system and rising interest rates. This could lead to a financial crisis if combined with existing issues in the banking sector. As of August 23rd, U.S. banks collectively held $3.26 trillion in cash assets, marking a 5.4% increase from the end of 2022. The recent failure of Silicon Valley Bank prompted a rapid demand for cash among banks, leading to an increase in cash assets to $3.49 trillion within 2 weeks. Banks need to maintain higher cash reserves to meet various financial obligations, such as accommodating customer withdrawals and offsetting potential losses from loans. The decline in bank reserves held at the Federal Reserve, coupled with concerns about a potential shortage of U.S. Treasury bills, has raised alarms among investors regarding potential stress in financial markets. Schectman says the banking system is in trouble.
The national debt right now is up almost really darn close to $2 trillion since they raised the debt ceiling. And, it took almost 210 years to spend our first or to go into debt for our first $2 trillion. And we did it in, a few months. This is reaching a pace of stupidity, and it's going to begin to really affect the banks as well, I think, as rates continue to rise. And look, I think higher rates are going to become a self-fulfilling prophecy because a lot of these holders, this is what we're seeing continually, are switching their 1% or less yielding bank accounts to T-bills and that are yielding 5%. And that's why the banks have to sell their loss-making, long-duration treasuries just to be able to pay those deposits that are being withdrawn. And this will force constantly higher interest rates for those long-term treasuries, and thus much larger losses on the treasuries or these unrealized gains. The whole banking system will get obliterated. And if you look at what's happening, just last week, we saw on a seasonally adjusted basis that bank deposits plunged by another 70 billion just last week. And so even more concerning is that in 6 months' time, and this is mostly to the smaller banks in the United States, they need to find $108 billion, these banks, because the bank bailout funding program has to be paid back in 6 months. And so there is going to be a lot more in the way of fireworks with the banks. You're seeing money just flee out of the banks, but maybe even more leaving not only the reverse repo market, which all of the money market funds are going into from the regional banks, going into the commercial banks, into their money market programs, which are being allowed to invest in the overnight repo market, which they shouldn't be allowed to do. The Fed should have stopped that a long time ago. It really would have put a brake on the exodus out of the regional banks, because as we've said before, you get 1% or maybe 0.5% in a savings account in a regional bank with the ability to go to a commercial bank that's too big to fail, paying 5.5% in the money market with daily liquidity. Why would you stay in a regional bank? The best rate you can get in a regional bank carries a 1-year CD at under 5%, locked in for a year. No reason to stay there. But all the money leaving the commercial banks going directly to the Treasury, and even draining down the overnight reverse repo market, the money in there pulling out, going directly to the Treasury because they're paying a higher rate than the 5.3% or thereabouts you're getting in the overnight repo market. You can get more than that in a 3-month Treasury. And, it's crazy because at the beginning of 2022, that 3-month Treasury was 0.06%. And now it's 5.5%, which is more than the overnight reverse repo market. It is draining the reserves from the banks, and it's a big deal. I truly believe it will be the catalyst for whatever comes next. And keep an eye on it. The end of the last chapter in the story of this banking crisis is far from being over. So, yeah, that's what I will stick to. It's going to be the catalyst for the next problem. And it's going to start right there with rates rising and money leaving the banks, making rates rise higher, which puts more pressure on the banks. And it's just going to obliterate the whole system.
Given the concerns raised by Andy Schectman about the banking system, the potential for bank bail-ins, and the trends in gold and silver prices, how should individuals and investors navigate these uncertain times in the financial sector, and what steps can be taken to safeguard their financial assets and interests? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 77% of our viewers have yet to subscribe. We're aiming to reach 3,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.